Section 1. The week in one sentence, a balancing act. This week, global financial markets performed a delicate balancing act, weighing signs of cooling inflation against persistent worries about slowing economic growth. Investors found themselves caught in a cross-current of information. Central bank commentary suggested patience. Economic data painted a mixed picture. Corporate earnings offered both reassurance and warnings. The push and pull produced choppy trading all week. Conviction was low, the mood was cautious. Section 2. Global markets. A world of waiting around the world, stock markets reflected this same hesitant tone, with regional factors adding unique layers to the global story of uncertainty. In Europe, equities watched local inflation. ECB pronouncements. Energy prices is a key concern. Asia, dominated by China. Fresh economic data under the microscope. Industrial production. Retail sales. Japan charting its own course. Emerging markets varied, driven by the US dollar. Overarching theme, a shared wait and see. Section 3. U.S. stocks, a tug-of-war between hope and caution. In the United States, major stock indexes like the S&P 500 and the NASDAQ Composite spent the week locked in a tight range, illustrating the deep division among investors. The week was characterized by a tug-of-war between competing narratives. One narrative focused on disinflation, which could allow the Federal Reserve to stop raising interest rates and perhaps even cut them next year. This view provided fuel for rallies in rate-sensitive sectors, particularly technology and high-growth stocks that had been battered during the Fed's aggressive hiking cycle. On these risk-on days, the market mood felt optimistic, with traders betting on a favorable economic outcome. Conversely, the opposing narrative centered on the risk of a hard landing, where the economy slows down more sharply than anticipated, leading to a decline in corporate profits. On these risk-off days, leadership shifted to defensive sectors. The week concluded without a clear victor in this ongoing debate. Section 4. Earnings Spotlight. The corporate report card. This week, corporate earnings reports provided a crucial ground-level view of the economy, and the results were decidedly mixed. A major technology giant reported quarterly sales that exceeded analysts' expectations. It's a bellwether for digital advertising and cloud computing. On the investor call, management issued a cautious outlook on future spending, highlighting rising costs associated with building out its artificial intelligence infrastructure. Another key report came from a leading semiconductor manufacturer at the heart of the AI revolution. The company delivered a blockbuster quarter, driven by soaring demand for its high-performance chips that power AI data centers. In contrast, the news from the enterprise software space was less rosy. A prominent cloud-based software company reported a slowdown in new bookings. The company said customers are becoming more cautious with their budgets. The market reacted swiftly and negatively, sending the stock lower. Section 5. Central banks and data reading. The tea leaf central banks remained front and center this week, their words carrying as much weight as their actions. The U.S. Federal Reserve was in a blackout period after its policy meeting, but prior commentary still echoed through the markets. The prevailing message: data dependency. The Fed will react to incoming inflation and employment data. Investors read that as likely steady rates next meeting, but one more hike remains possible if inflation is stubborn. CPI showed headline inflation moderating year over year. The market cheered. Core inflation strips out volatile food and energy prices. Core inflation remains stickier than hoped. Section 6. The bond market's verdict and commodity crosscurrents. The bond market, often seen as the smart money for its sensitivity to economic outlooks, had a volatile week. Early on, government bond yields ticked higher. The interest rate the government pays on its debt. This was a reaction to the stickier elements of the inflation report and the resilient labor market data, which suggested the Federal Reserve might need to keep monetary policy tight. Higher yields are significant. They increase borrowing costs for companies and consumers. In the commodity markets, crude oil was the center of attention. Prices swung as traders balanced conflicting forces. On one hand, concerns about a global economic slowdown. Gold, the traditional safe haven asset, held its ground in a stable range. Ultimately, gold's steady performance reflected the market's overall balance between rate concerns and growth fears. Section 7. What to watch, risks and road signs for the week ahead. As we look to the week ahead, the market will be searching for a catalyst to break the current deadlock. The primary focus will be on a new slate of economic data. Starting with fresh readings on inflation, such as the Producer Price Index, PPI, which can offer clues about future consumer prices. Perhaps more importantly, retail sales data will provide a direct look at the health of the consumer, whose spending accounts for the majority of U.S. economic activity. Any significant surprise in this data, either much stronger or much weaker than expected, could shift the market's narrative on growth. The corporate earnings calendar will continue to be a critical source of information. Beyond the scheduled data and earnings, traders will remain hyper-vigilant to a few key risks. In summary, the week ahead promises to be another exercise in reading the tea leaves. The central takeaway from this past week is that we are in a period of profound uncertainty. The most important posture is one of vigilance.